What's good, YouTube? It's your boy, Devin Payne. Welcome to the video, man. Hey, first and foremost, I want to thank everyone for tuning in to this week's video. If you're new to the channel, welcome. I drop videos just like this every week, helping to either supplement the information that you learned in school or straight up teach you things that you wished you would have learned in school regarding building and fixing credit, investing, and just personal finance in general. I also want to thank everyone for all the interaction on the videos, the likes, the comments. It's super helpful and motivating to me to keep pushing out content for you guys. But anyway, we're back with another banger for today. I know that a lot of you guys are interested in learning how to invest in the stock market, but let's be honest, when you're starting out, it can be a bit overwhelming. So it makes sense if you're on the fence. That's why I want to make this video for you guys today to inform you of 6 common mistakes made by beginners and even some seasoned investors as well. Now, let's get this video started. Now, the first mistake commonly made by investors is not considering taxes. Taxes are usually something that people just forget about when investing in the stock market because they fail to realize that you have to pay taxes on your capital gains. Now, capital gains are just the profit that you make after you sell an investment. The tax is split into 2 categories: short-term capital tax rate and long-term capital tax rate. Now, your short-term capital tax rate is the tax on the profit of an investment held for a year or less. Now, this is usually your usual tax rate. That must mean, on the other hand, that your long-term capital tax rate is a tax on the profits of an investment held for over a year. Now, this tax rate varies, but is usually lower than your usual tax rate. Another form of profit that you may have to pay taxes on are dividends, which you should be reinvesting. Now, dividends are just part of a company's earnings that they split amongst us as the shareholders in order to thank us for risking our money and investing in them. Now, one way that you can pay lower taxes or no taxes at all is to utilize a tax advantage account like a Roth IRA. Dividends and capital gains grow tax-free within a Roth IRA because you're depositing money that you've already paid taxes on in order to let it grow tax-free until you withdraw it when you retire. Now, the second mistake commonly made by investors is just waiting too long to start. I want you guys to let me know down in the comment section below if you've either heard somebody make one of these statements or if you made it yourself.
I don't have enough money to invest right now. I'm still paying off my car note, but I'll be done with that in a couple years, and then I'll have enough money to invest.
Or one of my favorites,
wow, the stock price increased from $10 a share to $15 a share. Well, it's too late for me to get in now. I'll just wait for the market to drop, and then I'll get in.
Guys, if you've made either one of these statements, I guarantee you're not alone. But stop it. No, seriously, stop it. By not investing as early as you possibly can, given your financial situation, you are literally costing yourself thousands by not taking advantage of the most powerful financial force on this planet: compound interest. Compound interest is this beautiful phenomenon in which your money makes you money, which then makes you even more money. So basically what that means is that $1 invested today is worth a lot more than $1 invested 10 years from now because your money has that additional time to grow on itself. For all of my viewers who don't believe me and need to see it to believe it, don't worry, I got you. As you can see, $1 invested at 20 years old at an annual interest rate of 8% will be worth $21.47 by the time you are 60 years old. Oh man. Now, that same dollar invested at age 30 rather than age 20 at the same annual interest rate of 8% would only be worth $10.06 by the time you're 60. Now, I know that may not seem like a lot, but realize that was a one-time $1 investment. So now imagine if you were automatically investing 5 to 10% of your paycheck. The money that you invest now can literally change your life in the future. Now, the third mistake commonly made by investors is not having a plan. Investing, especially if you're a beginner, is a beast. It's extremely easy to get overwhelmed because you're not sure where you want to go with your investments. Because of this, you need to ask yourselves, what is it that you want to achieve? Your investment plan gives you an idea of how long you will be in the market, how much you want to invest, how often you're going to invest, and your risk tolerance. Are you investing long term, maybe for your retirement? Or are you trying to grow your money fast in the short term to fund an upcoming vacation? Your investment plans just gives you some form of predictability in this ever volatile stock market. Now, the fourth mistake commonly made by investors is investing with emotions. Now, this is a heavy one because few people want to admit that they do it, but it happens. Fear and greed are some of the key ingredients to this volatile market. People fear loss more than they are excited about potential gain. This results in massive sell-offs at market lows, which lead to plummeting stock prices, which is obviously something that we all want to avoid. One way to curb this fear, if you're looking for a more reliable form of investing, is to think long-term and adopt a buy and hold strategy. That way you're not constantly on this emotional roller coaster that you voluntarily get on when you check your portfolio multiple times a day. Because guys, realize this, in the long term, short-term fluctuations do not matter. If I'm keeping this investment for the next 10 years, whatever it does next week means nothing to me because I'm not even worried about it because I'm in for the long run. The market is always hitting new all-time highs. We see it all the time. If it's a good investment and the financials make sense, then go for it. At the same time, just because a stock has been good to you in the past, realize that you don't owe it anything. You're investing to make money. So if something major were to happen to the company, like a new and reckless management team takes over, and now the price to value ratio just doesn't make any sense, then it may be time to sell. Leave your emotions out of it. Don't let me find out that y'all are out here falling in love with these companies. Now, the fifth mistake commonly made by investors is not doing your own homework. Now, I know I say this a lot, but this is another big one. Because too often when people are investing, they tend to think that they're in over their heads, so they turn to the next guy and take their advice and their portfolio as gold. And they never do their own homework. But realize, in virtually every single scenario, and I'm really leaning towards saying in every scenario, your situations will be different. Whether it's your entry points, did you guys buy at the same time? Probably not. Whether it's your financial situation, do you guys have the same amount of money that can be allocated to investing? Or your risk tolerance, how much can you handle? How much can they handle? In addition to this, you should only invest in things that you yourself understand. Can you explain what it means in just a few sentences? Can you explain what the company does? If you can't, then you are going to feel helpless when all of a sudden news breaks that something's going on within the company and you're wondering to yourself, why is the stock collapsing? And now you're blaming someone else for losing all of your money. When in reality, who else are you going to blame but you for not doing your own homework? This is a terrible situation to be in, and trust me, I felt it. The sad truth is that everyone thinks that they're an investing wizard in a bull market. It's okay to get advice from people. It's okay to ask them, but make sure that you're really understanding why they're investing in this company. And once it makes sense to you, if you still think that it's a good investment, go for it. Now, the sixth mistake that is commonly made by investors is investing too much. If you're new to investing, try to start out slowly until you no longer panic when you see your portfolio is red. A general rule of thumb is only invest what you're comfortable losing. If you're only comfortable losing $100, invest $100. If you're comfortable with losing $1,000, invest $1,000. If you have deep pockets, go ahead. All the power to you. If your heart is dropping every single time you're about to check your portfolio, that is a bad sign. What I mean is, if you need this money in the short term, then you probably shouldn't be investing that much. Investing money that you may need in the short term puts you at risk to sell at a loss during market fluctuations, which you obviously never want to do. You really need to take a step back and ask yourself about your risk tolerance. Okay guys, so those were some of the 6 most common mistakes made by investors. If you've made any of these mistakes, comment down below. Let us know. We'll all learn and grow from it. If you made it this far into the video and you're not yet a subscriber, feel free to subscribe so you won't miss any content. If you enjoyed the video, be sure to caress that like button until it turns blue. I'll see you guys in the next video. Peace.